Okay, welcome back. We've got the market, which is roaring 200 points nearly, 20,100, almost there. Shibani Sircar Kurian is Senior Executive Vice President and Head Equity Research at Kotak Mahindra Asset Management Company. Shibani, good to have you with us here. Thank you very much. The exit poll results are tomorrow, and I just wanted to, this is not so much a long-term question about where stocks, etc. are headed, but do you think the market maybe is sniffing a particular kind of outcome tomorrow? Is that what's going on here today? And I mean, yesterday, the strong rally we're seeing?
Hi, Prashant. Good afternoon. So, as you rightly said, this is something that I think the market will take in its stride, focus more in terms of what's happening, in terms of earnings, and of course, going into the general elections for the next year. So, I think what for us, the standout feature from a market perspective has clearly been earnings delivery. And if you look at the last 2 quarters of numbers that have come out, one, overall earnings have actually been better than expectations. So there have been some minor upgrades that you have seen for earnings estimates for FY24 and 25. And secondly, and most importantly, the earnings has been fairly broad based. And therefore, I think that has been one large factor driving markets apart from flows, which have been strong on the domestic side. And you've also started seeing that the kind of FII selling that we had seen in the past 2 months has abated. So I think it's a combination of all these factors that are, impacting markets positively. Going forward from here, a couple of things that we have been, discussing even in our past shows. From a valuation standpoint, what we have seen is that if you look at the last 2 years, the large cap profit pool has increased significantly by about 35-40%, while large caps in terms of market capitalization has gone up by only about 13-14%. So therefore, in terms of comfort on valuations, especially where large caps are concerned, the valuation comfort is clearly there at this kind of market levels. In terms of the overall sectors, what we are really seeing is that domestic facing companies continue to perform better, and within that, B2B is better than what we have seen.
Shibani, afternoon. Reema here. Where do you stand on oil marketing companies? The month of November has been blockbuster. HPCL is up 38% in November. BPCL is up 22%. IOC is up 20%. Consumption is strong. There is a possibility of an upside to GRMs. Crude prices have been fairly benign now. And valuations too are not unreasonable. But is the best in the price, or is there a tactical or a structural trade in oil marketing companies from here on?
Hi, Reema. I think it's more tactical in nature. So if you looked at what's been happening with oil prices, there has been significant amount of volatility. Having said that, if you look at our view, we believe that globally demand continues to remain fairly muted. And from that perspective, if you look at oil prices, from the demand side, the overall trends are fairly muted. However, what has been impacting prices has been more supply-led, and therefore the volatility is largely supply rather than demand. So from that perspective, as oil prices have corrected from the highs that they had touched earlier, we have seen that kind of tactical play in the oil marketing companies, as well as you rightly pointed out, that valuations have been fairly reasonable and fairly attractive, which has resulted in the kind of up move that we have seen in this space.
Okay. Shibani, hi, good afternoon. So let's talk about financials, the underperforming side of the market, right? Particularly the larger banks. And I think that's almost become a consensus call now, given valuations, given that these stocks haven't run up. But beyond some of the larger blue chip banking names, what else would you look to add to the portfolios now?
Hi, Surabhi. So I think one space within the overall financial construct, of course, we've spoken, earlier about the large banks, etc. But one space in the financial sector where we are incrementally turning positive is the overall insurance space, specifically the life insurance basket. Now, as you know, over the last 3-4 years, the sector has seen significant amount of turmoil, starting with the COVID impact and then the kind of impact that it had because of the change in terms of tax regulations on the non-par side. Incrementally, what we are really seeing is that growth seems to be coming back, especially where protection is concerned. And therefore, if you look at the monthly data on sum assured, you will see that data growing at a fairly steady clip, which again points out to improving trajectory on protection, which again is a high margin business. Now, for some time, because of product portfolio mix shifting away from the higher margin non-par, you are seeing that kind of impact quarterly in terms of margins coming off, but growth coming back bodes well for the sector as a whole. We believe that some of the larger private players in the space are gaining market share and are able to deliver fairly well in terms of return ratios as well with reasonable valuations. So that's one space incrementally within the financials pack where we are turning positive.
What about NBFCs, Shibani? Anything you like there? I mean, Sundaram Finance is up sharply today. And generally, I mean, that's a space where, actually not NBFCs so much, but banks where valuations are still quite okay for most part. But particularly with NBFCs, what do you like?
Yeah, so NBFCs has also been a sector where we've seen significant improvement on the growth trajectory. So the way we have played NBFCs is looked at companies which are present in segments where they clearly have market share and they are dominant in that space. So therefore, they have a niche in a particular segment in which they are operating in. We've looked at companies where their asset liability profiles are matched and therefore the ability to manage margins has been better. And of course, finally, parentage. So there are pockets within the NBFC space where still valuations are reasonable and where we continue to remain positive on.
Okay. Any sort of specific segments there?
Yeah, so for instance, within the auto financing space, again, remember a number of these players are those which have books or the loan books which are fixed rate in nature. And therefore, in the last cycle, they've actually seen margin pressure. But however, now as the fixed rate book starts to reprice, NBFCs will start seeing some amount of margin pressure abating. And secondly, going into next year, whenever that happens in terms of a rate cut cycle, maybe sometime in the middle of next year, NBFCs, which are again more wholesale funded, would tend to benefit. So there are pockets, especially within the auto financing space, some names within the microfinance space as well, where we've had positive views. So the overall pack is something that we like, but we are mindful of valuations, specifically given the run-up that you have seen in the recent past.
Any of the pure play digital companies which catch your attention and fancy, the Zomatos and Paytms, where we've seen considerable progress on profitability?
Yeah, so absolutely. So, but our approach to the entire new age digital pack has been fairly cautious. So we've looked at a few companies. So what we have done is we've had a framework in mind when we've evaluated these businesses. First and foremost, of course, is the path to profitability, and therefore companies which have had or have demonstrated improvement and move towards the profitability path, those are companies that we have liked. Secondly, these companies, of course, there are many of them, but those which are present in segments where competitive intensity is lower, and therefore companies have the ability to gain market share or entry barriers have been low. So those are again segments which we have liked. And finally, I think capital allocation has played a big role in us deciding on which of these companies to invest in. So we've had some of these names in the portfolio, but we've been evaluating each of these names very closely on a name or a case-to-case basis.
But you do own some of these technology plays where they've shown some progress in profitability or have turned profitable.
Yes, we do. Yes, yeah.
We do.
Yeah.
Okay.
So, Shibani, before we let you go, in your latest note, you do point out that valuations are obviously they're comfortable for large caps, but for mid caps and small caps, that's where valuations have moved above the long-term, historical averages that we've seen. So, given this, where do you see the red flags, particularly in small caps? Which are your strict, let's say, no-go zones? Leave us with some advice over there.
Yeah, so as you rightly said, if you look at the large cap space, in fact, if you look at on a 1 year forward basis, large cap as a pack are trading at a slight discount to the historical averages. Mid caps are trading at a slight premium and small caps are trading at a significant premium to their historic average multiples on a 1-year forward price to earnings. Here, I think what we are really saying is this is a time to evaluate companies based on their business fundamentals and management quality, and then marry the same with valuations, and therefore look at good quality businesses which are today available still at reasonable valuations. But of course, when you are looking at companies where fundamentals and valuations don't go hand in hand, those are the pockets to be cautious on. As
But
a
as
rule,
such, so sorry, I was just trying to understand, as such, in terms of a theme, do you see froth anywhere? I mean, whether it's defense or railways or, I don't know, EMS, is there any such one sort of large pocket where you see things have gotten a little excessive?
So I think, the way I would, put it is that if you look at the overall segments where we are still positive on are sectors which are largely B2B in nature, where you are still seeing growth trajectory being strong and profitability improving. So within the domestic space, we have been positive in the entire capital goods, infrastructure, manufacturing pack. But again, there we are wary of companies where valuations have run ahead of fundamentals. So while we are positive on the theme per se, but we will be staying away from companies where valuations are expensive with respect to the overall outlook on earnings, even within the pack. The second space, of course, has been financials, and we discussed the same. And the third segment where we have been positive is the auto ancillary pack, where we think valuations are reasonable and growth prospects continue to improve. And finally, the building material space, which again we think has not really performed in line with the kind of the upmove that you have seen within the real estate sector, for instance. So these are the 4 areas where we continue to remain constructive. But I think the key takeaway from me has been that overall domestic businesses continue to perform better, and therefore, good quality businesses which are still trading at reasonable valuations. It's tough and hard work, but you're still getting some of those names and identifying such stocks and opportunities.
Thank you very much for joining in, Shibani. Let's get in a few technical trading calls. Mitesh Thakkar is back with us. Thank you for watching CNBC TV 18. For all our top stories and news updates, follow us on our social media platforms.